All right. Well, thank you all for having me, and thank you guys for taking the time out of your schedules. It's probably beginning to be a long day. I know you've been here for a while. There have been right many speakers here, but hopefully it's been well worth your time. And I like to say that it's my job to deliver you a nugget or two. And I'm not trying to change your whole trading philosophy. I'm not trying to, change your whole trading, what you're doing well. What I'm here is to just give you a nugget, hopefully, as an early Christmas present, if you will, that will help your trading out for 2015. Now, I'm not going to spend a whole lot of time. Reed just did an introduction, so I'm going to go over and get through a lot of the housekeeping really quick so we can get to the nuts and bolts of the presentation. As most of the presenters before me, we are using under the CFTC rule 4.41. Hypothetical and simulated performance results are being presented here. No past performance is not indicative of future gains. These trades that I'm showing, although I have taken some of them in my own account, some of them are hypothetical and are for teaching or educational purposes only. All right, so since Reed kind of went through my background, small town Virginia, I've been around the markets for quite a while and been a professional for going on about 9 years now and been moderating for over 7. So I do have some time, and I will tell you those first 2 years that I traded were, and you'll probably wonder how, but they were like about 6 years worth of experience packed into one, because what I did was I did do a lot of testing. I replayed each day about 3 times. I would trade it live, and then I would trade it, knowing what happened, and then I would trade it, testing out different methodologies and things like that. So I've got a lot of screen time, and that's one wonderful thing about this profession is we do have a lot of information at our fingertips, and I'm going to try to put a wrapper on how you can use some of that information to your advantage today. But before I get into that, there's one thing that I need to discuss, and that's how big is your why? How bad do you want to be a successful trader? And the reason I ask that is because the markets, other professional traders, just life in general is going to knock you down. And you better have a big why in order to succeed in this. And that's not meant to scare you or deter you. I think this is, pretty much for anything that you do that's worth pursuing in life. You're going to get knocked down, so be ready to take those jabs and jump back up. In the boxing arena, it's not how hard you get hit, it's how quick you get up. And a lot of times that can, even if you get knocked down, the psychology of jumping right back up after the guy knows he's landed a great punch, that will make him think twice again, because he will know that, man, I gave it my best shot, and this guy or gal just jumped right back up. I'm not phasing him at all. So make sure your why is big enough. And it wasn't until I figured out my why and that I really began to take trading as the business that it is, and treated it as a business, watching my P&L, managing my employees, i.e. my setups in the market. And that's this right here. Reed talked about Jackson and Carter. Well, this on the right is Jackson, and the guy hiding his face is Carter. These are my pride and joy. These are what I live for, and this is my wife. And just spending time with them and being able to have a flexible schedule to where I can, jump out of here at 3 in the afternoon and go, take Jackson to a ball game or do whatever. That's what means the most to me. And I will tell you, for those of you who play golf, I'm going to have to change my bio because I'm actually giving up golf. I'm only going to play in 4-man tournaments because it's a little too tiresome running after my ball when I hit it myself. So I'm going to have to change that, and we'll have to update and find a new hobby to go through. I've been playing golf about 22 years, and I'm not getting any better. So I talked about, how big is your why? My why is not too big in golf. I have no reason to keep putting myself through that misery. So that's my background. That's why I'm here, and that's why I'm bringing you this information, because some of you may be in the situation that I am, in corporate America, just trying to get out of the daily grind and increase your flexibilities to spend more time with your family or spend more time on the hobbies that you enjoy pursuing. So that's what I want to talk about today. and I want to talk about, whoops, I skipped a slide. I don't think it was important. Oh, it was just the agenda. So I want to talk about how you can, make steps to do that. The first thing we're going to run through the first section really quickly, and it's about having a plan. I'm going to offer you a real quick 3-step technique that you can apply to your setups, and put this wrapper around any setup that you're looking at. And then I'm actually going to take you through a portion of my trading plan that I use on a daily basis, and that's identifying the tops and bottoms. And then we'll round it out with a couple of examples. So the first thing is the 3-step trading method, and at Trade the System we teach 3 different phases of the trading plan. We want you to identify the trend. And I actually heard a speaker or two before I got on here, and they did something very similar, which, like I said, what we do is we take what works for us and we apply it to the markets. I learned from coming to these type presentations, from actually paying for mentors. Even I still pay for mentors from time to time. If it's something I don't know about, I don't trade options on futures. So when I go to trade options on futures, guess what I'm going to do? I'm going to find somebody in the industry that trades options on futures, and I'm going to go pay them and sit by them for their expertise. So it's not going to be earth-shattering information, but what you're going to find is you're going to take these components, the trend, trigger, and supervision, and you're going to, whether you call it this or whether you call it something different, you need something that's going to stick with you, and hopefully this will. The key here on this slide is in identifying the trend, because we're not only identifying the direction of the trend, we're also identifying the phase that we're in. So if you've been in an uptrend for 12 weeks and you're trying to capture a little bit of that uptrend, do you really want to wait for a pullback, or do you want to buy a breakout? And that, to me, if you've been in a sustained uptrend, the breakouts get more and more risky. Now, buying pullbacks until the trend is your friend until it ends, right? As long as you're buying pullbacks and reducing your risk, I don't see any problem with that. I don't care what stage of the trend you're in. At least you've got a target that the market can go to, and you know when to start reducing your risk. So not only the direction is important, the phase is also important, okay? And then what I'm going to be focusing on, and I'm actually going to give you a start to finish trigger plan. So I'll give you a way to identify your trend, and I'm going to detail how you can actually set up your entry criteria. And then there's multiple ways to supervise the trade. And supervision is where you make your money, but it's also, once you get away from the emotions, it's one of the easiest things, because it's a pretty simple concept. If the trade's going your way, you let it run. You don't have to worry about it. If you get 22% in 3 days, how many of those do you get in a month? You probably, you want to be realistic about it. You're probably in a good trade. It's going to pull back. Nothing goes straight up and straight down. So a little common sense takes over in the supervision phase. So let's get into, how we're going to help you, number one, with your trend and your overall trading plan, but specifically your trigger. But before I do that, I just want to leave you with this thought before we go to the next section. It does not matter if you use our Trade the System methodology, the trend, trigger, and supervision, but you've got to use a plan. Take something that you've heard from one of the other 9 speakers and incorporate it into a trading plan before you start 2015. Because if you've traded 2014 and didn't have a plan and did not blow your account out, consider yourself lucky. Because we're trading, we're against professionals who actually know what they're going to do on a day in and day out basis and have already made their decisions. They're not acting because they're making or losing money. They're acting according to their plan, and that's very, very, very important. If you don't remember anything else today, remember this particular phrase. Make sure you have a plan to trade these markets. Okay, so let's talk about my Christmas gift to you, because you can do this structure without any tools. Now, obviously, my job is to help make it easier on you, and I'm going to try to do that at the end of the presentation, but I'm going to show you the nuts and bolts of catching potential tops and bottoms, okay? Now, the first thing we've got to talk about is we've got to talk about structure, market structure. And what I want to do is just have you look at this chart. You've looked at 8 million charts just like this. But what you failed to notice is the hidden clues on the market structure. Is this market coming down, making new lows, and then taking off? Is there a way that we can define this area over here to the right as a bottom, and how do we limit our risk when we do take shots to the bottom. And that's very, very important, okay? We're going to talk about when you just have a harami candle or an engulfing candle and whether you have continuation in the price. So we're going to look, I call these simple price pivots. They're just, it's pretty much noise in the market. It's where the move is going down and you get one time period. This could be 1 minute, this could be 144 trades, it could be a 2-hour chart. I don't really care. The fact of the matter is, for one time period, you had a stop in selling and a little bit more of buyers being aggressive, okay? And we come over here, and right here, you had a decision made by the markets. You had a stop in place or a stop in momentum and then a reversal of the trend, okay? These two lows, when you compare them with the rules that I'm about to give you, are going to identify this as a low-risk top or bottom. So let's go ahead and build upon this just a little bit and talk about why it's important to look not only at indicators, but why it's important to look at price. And the reason it's important to look at price is because the price, these candlesticks, are nothing but details to emotions that traders have went through, okay? And where there is emotion, there's history, and the history is going to lead to clues. So you see right here, we made an indication to go up, and then the decision was made to take it lower. Well, this area is where traders position themselves, both long and short. So that's going to have an effect when you come back to it. There's, support's broken, it's going to become resistance. And right here, when we start drilling down, this is a 2-minute chart. To a day trader, this is an eternity. To a swing trader, this is a blip on the screen. But the things that I'm going to show you will show up, I don't care what kind of chart you're on, okay? So the history right here for a day trader is that the 2-minute area is right here for resistance. So you peel the onion, so to speak, you look inside the candles here, and you can spot low-risk tops and bottoms at these key areas. So whenever you're whenever you're kind of scratching your head, just look left on the chart. You'll be able to see it on your higher time frame charts where the market turned and where we made decisions to go either lower or higher, okay? So let's go ahead, and again, we're going to continue building on the building blocks here. We've got market structure under our belts. Now we're going to add a component called indicators, and in this particular presentation, I'm going to focus on oscillators, and you've heard some of the other guys use a couple of these. I'm going to use them in a little bit different way. And that's the boring Investopedia definition. Let's just tell you what the oscillators I'm going to be using. Anything that goes overbought, oversold, specifically like the CCI, the price channel, which is a trade, I think it's a TradeStation indicator. I'm not sure the other platforms have adopted it yet, but they will soon, I'm sure. RSI, stochastic, and then the one that doesn't go overbought, oversold, but it's a really good indicator is the MACD, and it goes, you have buying pressure taking over and selling pressure taking over. So it oscillates from high to low ranges. So that's what I'm going to do, and you couple the oscillator with the price chart. The Keltner channel is overbought. Yes, but it doesn't wave like this. I call a Keltner channel, I group that with like the LRC channel and the Bollinger Bands. They're more predictive indicators. They're not really oscillators, okay? So I'm going to kind of put that in a different category. And it may be splitting hairs there, but it's hard to, you can't spot really divergence on a Keltner channel as good as you can on some of the oscillators like the ones I have listed here. But great, great point. Do I think that you can use the Keltner channels, the linear regression channel, in conjunction with what I'm going to show you here? Absolutely. You absolutely can. And we have studies, that we obviously use the Keltner channels and LRCs for as well. That's kind of a different presentation. So when you couple the market structure and the oscillator, you get this phenomenon called divergence. And I am a huge, huge proponent of divergence trading because I think it gives you the hidden clues. Now, a picture's worth 1,000 words, so I'm not, again, I'm not one to bore you with definitions. I like pictures. I told you guys I'm from small town Virginia, so if you start putting a whole lot of words on the screen, it bores me, and it kind of it gets too complicated for me to understand. But I understand price and I understand indicators. And I understand the relationship when you have price going one way and the indicator going the other, my eyes light up. My dollar signs, go all over my head. I do know that, there are losing trades and I can get faked out, but I do know that I can control my risk very, very well by using divergence in the markets, okay? And a lot of times it's divergence, it's the hidden clues that other traders fail to see. And more importantly, trading futures is a zero-sum game, okay? In order for me to win, somebody else has to lose. And the divergence patterns are patterns that suck people in one way and are the easy first target trades that will get me to risk-free so that I'm not trading against the seasoned professional with my wallet on the line. I'm trading with a even emotion. I've already, controlled my risk. I know I'm not going to lose money, and I can make my best decisions when I don't have, my P&L going up and down all the time. So that's one good thing about playing divergence trades. The bearish divergence has an evil twin called bullish divergence. As the market's going down, we're going to spot bottoms. For when price makes new lows, we're going to look for a strengthening indicator, okay? Actually, I've got, whoops, sorry. Okay, no problem. And so let's dive into the divergence, and let's spend most of the time creating our trading plan around looking at charts that are going to give you the opportunity for low-risk tops and bottoms. Step one, I've got a 1-minute chart here. Like I said, you put the chart time frame of your choice on this. We've had a good run-up in the Dow. This is actually, believe it or not, I updated the slides. I try to do this to make them relevant. I try to make them relevant on each presentation. So this is today's move. This is 11:20 this morning. And you can see we put in a potential high, and then we made a new high. Now, I've told you, this is market structure, correct? No, everybody and their brother, everybody who was trading today knows the indexes went nuts. They started going up at about 11 o'clock, and they didn't look back. You can see 200, almost 150 points. But the top, remember, low-risk tops and bottoms. If I buy this market, where's my previous level of support? It's 75 points down here. I can buy this market with a stop somewhere down below here, and I don't really know that the uptrend is over until we break this point right here. That's a very, very, very high-risk trade. Okay, you've got to risk a lot, and very seldom are you going to make moves like this in the stock index futures. But right up here, look at what the market is telling me. It's making a new high, and then when it pushes up to this high and gives me this red candle, what do I have in place? I've got 2 pivot points, 2 price pivots. Okay? In order for me to take a shot, I can risk this little bitty amount. And I'm supposed to have a crayon. Here we go. Here's the pen. So we can risk, oh, that's a great color, isn't it? Oh, me. It's not good to use black on a black background. We know right here on this particular red candle, we know that we can go short and place a stop above this, and if the market continues its uptrend, we get stopped out for a very, very, very small loss. But look at the profit potential that we have if we're correct. We short right here, we place a stop right here, we know that our first target is down here. Okay, you hit your first target, check. Now you're break even on the trade at worst. If it goes from here back up to here, okay, we break even, right? But look at the potential you have, look at the chart space you have in order to take advantage of if you're correct. Now, you don't even have to catch all of this. Even if we just come down to this little minor support level, you've made a very good trade. You've picked up 100 points in the Dow or 500 bucks in less than a day. This is a 1-minute chart. So that would be, what, about 45 minutes to an hour? Not a bad return there, okay? So let's build upon this. And I got to erase my drawing here. All right, let's build upon this and add a step, because just any time there's a red bar, that gives us a lot of risk, right? So let's look at this on the next step, and let's add one of those oscillators that I was telling you about, and we'll see if we can get it to show you. There we go. So on this push up, I told you every move is not created equal. Well, look right here. You're making new highs. The indicator is pretty much making new highs. It pulls back, price stabilizes, you push to new highs, the indicator makes new highs. Okay? We get on consolidation, and then we get this huge run. Okay? So what we're looking for is we're looking for a little pullback and new highs. We never got it. We got sideways consolidation. But when we got this big candle, a pullback, and then a new high, look what happened to the indicator. The indicator never even made it, it barely made it back to overbought. That there, this situation coupled with this situation, that equals risk, low risk, and you've got plenty of room for it to come back out these. So how do we quantify that? Well, that's called divergence, okay? And as soon as this little low right hits, you have a trade setup, okay? I talked about identifying the trend in that second, okay? So right there is the basis of our trading plan. Take this thing and dissect it a little further. Whoa, that didn't work too well. There we go. So this is step 2. Let's add step 3. We know, I told you, you got the trend, right? So you identify the trend by picking predictive levels, right? You've got pivot points. The previous Richard talked about Keltner channels. I've told you about, you know, LRC channels and things like that. When price is outside of those levels, where does it go? It's going to come back to the mean, correct? Well, what do we need to make profits? We only need a fuel move to take off our profit, get risk-free, and then see whether the trend will continue or whether it's going to end. Okay, and if it ends, we're positioned with a low risk top and bottom. Now, what I've done is I told you I wanted to make your life easier. Well, I've developed something that does that for you. It's the divergence indicator. I call the ricochet. I'll get back to that in a few minutes. What's more important is that you need this structure, regardless of whether you've got an indicator, and we talk about plans. So let's talk about the entire trading plan. The first thing we're supposed to do is identify. Is anybody and their brother at 11:20? We were trading this morning right before the presentation started today. Is there anybody that would argue that we were not in an uptrend? Okay, everybody would say that they're in an uptrend. The market was rolling; those were shifting to bullish. The ticks were up around 600-800, and the market in a price uptrend and volume was coming in. Everything was looking wonderful. Well, that's called the normal range of the market, and it gets expanded from time to time. But when you get outside of 120% ATR, when you get in between the daily ATRs, price is more than likely, and I'm talking to the tune of over 85%, is more than likely to close the day under this line. Well, if I know that price is more than likely going to close inside our range, then what in the world am I doing saying, hey, the trend is to the upside, so I'm aboard to the upside, right? I've identified the trend is up, but I've said, hey, it's gone as far as to go. So I want to take a planned short trade, but I do it in an area that I can define my risk and I know when I'm wrong. Because remember, 85% is not 100%. There are times that the Dow can close up 300 points. I've seen it. I've sat through it before. So we've got to have precursor. In this particular example, the daily ATR is the precursor. You take the trade, and in this case, it ended up working out. There are cases where the trend just keeps on going there. At 17,400, you may get another divergence signal. Well, I will up to, so you can put in your trading plan when I'm outside the daily range, the normal daily range, and you can define that by ATRs, or you can define that by pivot levels. If you're outside of R5, that's a reversal time, or if you're heading into R4 or R5, a lot of times it rejects price. So there are multiple ways that you can define that. If you're outside your LRC, if you're outside your Keltner channel, for those of you who like Keltner channels, you're going to want to play counter trend versus trend following, okay? And so that's the kind of the building block approach that I take to the markets. If we're down in here, I want to be on a time frame that I can get long. If we get up here, I want to identify the areas that we are going to revert to the mean, okay? So let's add some more and show some more examples to get us in the, to make sure we understand this. I've switched to the Russell now, and this is a past example, not from today, but the Russell was chopping around and then it started an uptrend. Well, we had this pegged as a potential top, okay? And what you will see is the oscillator never gave us the clue. So on this high, we never even shorted the market. We pulled back on this high. We never got a short signal. But when it pushed to 1,086, we had a difference going on in the markets. Now let me show you what I'm talking about. On this high, this was the corresponding high to the stochastic. On this particular high, look at where the stochastic topped out at and rolled over. And that was on this price bar. So right here, we knew we had structure in place for a low-risk top. And that was, in this case, based on the stochastic. Okay? So we took the short. Where's our stop going to be? Stop's going to be above the market structure, and we're going to look for the previous low as a target. We're going to take half off at the previous low. We're going to bring our stop down to break even, and we're going to see if the trade, if we've called a really nice top or if we've just caught a nice little retracement move to bank us a little bit of money. Okay? Low risk tops and bottoms, it's not like catching a falling knife. You want to systematically have a place where the market has a higher probability of reversing or ricocheting off of that level as opposed to continuing through that level. So what are my favorite trading setups? I've hit upon that trading plan that I wanted to introduce you to. I've hit upon a lot of things that I do on a day-to-day basis. So let's look at how this comes together in the real market. And what I'm going to show you the divergence indicator that I use and that I've developed. It's called the ricochet, and it shows it's not anything magical because there's not a whole lot of new things out here in the market. But what are the best indicators used for? They save you space and they improve your decision making. Okay, this indicator does both of those. It saves space on your chart so that you can look at really, really important, like volume or other indicators. And also, it just shows you when the divergence is present so that you can say, what part of the trend am I in? And if I'm in an exhaustion phase, I can take that counter trend signal. If I'm in a trend following phase, if I'm in the beginnings of a new trend, then I want the divergence in the direction that the market is trying to show me to go. So I want a minor pullback, a scalping chart, if you will. And scalpers can use it to follow the trend. It's not just a counter trend entry tool. You can spot minor pullbacks and you can get these patterns on your major chart. Okay? Longer term traders can use it to spot reversals. If you've got exhaustion indicators, this is a great little entry trigger to keep you from getting run over by a freight train, if you will. And it complements the other tools and filters like parabolic that eliminate or that would cause you to step in front of parabolic moves, like pivots. Okay, have you ever been sitting there looking at a support or resistance level, support 1 or resistance 2 or something like that, and you're scratching your head? You're like, well, it's supposed to fall once it gets here. It's supposed to pull back a little bit. This should be an area of resistance. It hits that level, it never looks back, goes to your stop, and just keeps on cruising. You were completely wrong. You were stopped out in about 30 seconds, and the market's taking your money, and you're left scratching your head. And 30 seconds is an eternity if you're trying to trade a crude oil pivot, because crude oil can stop you out in about 3 seconds. But we'll get to that later. It does complement, and it allows you to keep from getting run over by a freight train. So let's look at this, the ricochet. What I've done is you've got CCI, you got this is the price channel. It's a different price channel that I made. This is the regular price channel for TradeStation. Here's the MACD, the RSI, and the stochastic. Well, you could have all of these on your chart, and you could be sitting here looking at each one of these moves, and you can barely see price, right? You can barely see price. I'm sitting here looking at the indicators. By the time my eyes have looked through all these indicators, squinted back up here to price, I've probably missed the move. So what the indicator does is it takes all of these oscillators and it just puts them in here to where you don't even have to have them on your chart. Okay, so you're in a downtrend. You'd see that by the exponential moving average ribbon here. This is nothing but a moving average ribbon. I call it the slingshot because the other moving averages are triple weighted exponential. They're really, really fast. You can actually use the crossovers as entries, but again, that's a different. I'm too worried about the trigger here, and I want you to figure out, you've already got their trend identified, so when you get this trigger, there's no hesitation. Red dot is a selling opportunity. I know my risk, and I know my first target is going to be that. Whoops. I know my first target is down here. Okay. I'm going to exit half, reduce my risk, and move my stop to my entry and see how far this thing will go. Well, how far is this going to go? That gets into the supervision of the trade. You can follow it down by market structure. You can follow it down by moving averages. Or you can do like the previous speaker talked about, you can have Fibonacci projections or Keltner channels that you're targeting. And when it's outside the Keltner channel, cover your trade. Don't, bulls make money, bears make money, pigs get slaughtered. If you're trying to be a pig and trying to hold, for some just, if the average true range is 150 in the Dow and you're up 300 points, you probably need to take your profits. Like I said, a little bit of common sense goes a long way in the form of trading. So let's look at a couple of other examples. This particular example gave you 2 entries in the downtrend. This particular example is crude oil. This is trend following with crude oil. So you get the up move, you get one divergence indicator. This is the value chart divergence. This is the price channel divergence. You get the red dot, you've got a red slingshot channel, you're expecting a continuation to the downside. The interesting thing is with the filter, do we get run over by these particular indicator or triggers? No, we don't, because we know there's a downtrend. So we just ignore the ones that are not in the direction we want to take. This right here would have got you short at about $56.80 because you're not going to catch the top. I think this one went to about $56.86. You're not going to catch the top. This is a 144 tick chart, so you're going to have very, very little risk. About 12 ticks, 12 to 15 ticks in crude oil. It actually came down here. The overall move was 55.90, and then it started chopping around for about 45 minutes. That's a $900 move in 1147 to 1150 in about 15 minutes in the crude oil market. Okay, not every trade is going to do that in crude, but crude has the ability to break out, and when it does, all you do is take your hands off the mouse, and it just runs. It makes new lows, makes new lows, makes new lows, comes back up, makes new lows. You get down here, it consolidates dead sideways, you bring your stop down. If it breaks lower, you're fine. You take your hand off the mouse, you let it run for you, okay? So you stay out of your own way when you get into the tops and the bottoms, because remember, we're spotting the hidden clues. A lot of traders are on the wrong side of the market. What fuels the market moves? Traders' stops. No stop goes untouched, right? Well, people who got long thinking this was a bottom, they've got stops cascaded all the way down through here. And that's why you get these erratic moves in things like crude oil and gold. Indexes occasionally, but they more, they'll come down, probe here, and then make new highs and then make new lows. They're kind of wishy-washy when it comes to running like this. Okay? All right. How much time is it a 144 tick bar? Mike, it's 144 trades. So sometimes it's 5 minutes, sometimes it's 3 minutes, sometimes it's 20 seconds. During the FOMC announcements, which we have tomorrow, a 144 tick chart it'll give you probably 15, 20 bars in a 1 minute time frame. So it's based on the activity of the market. Okay. Yeah, good. So let's talk about the CCI indicator on gold. Okay. You've got your indicators over here. These are nothing but moving averages. We're in a downtrend since 10 o'clock this morning. The gold market broke, it went down, and then it tried to retrace. So what are we looking for? Well, as long as we stay below 1199.43, or as long as we stay below this green line here, we're looking for shorts in the market. Okay, boom, we get a CCI divergence on the February contract, and you can see it right here. You get a move up, a move down, and a move up. Right here on the CCI, you get a high right here and a lower high right here, and that's enough to trigger the indicator and to trigger the trade. If you don't want the indicator, or if you don't like indicators, that's fine. Look for these patterns. It's a little harder to spot if you don't have something mechanically showing it to you, but you can run these oscillators and just look for these divergence patterns. They are very, very great at calling the tops and bottoms, and the most important thing is you know your risk. When you short the market right here, you know that your stop goes a couple of ticks above the high of that candle. And that way, again, small stops, big runs, right? I mean, this is a 6-point move in gold, 600 points per contract. Stochastic does the exact same thing on the Dow. The Dow's in a downtrend in this particular example on a 5-minute chart. I'm just showing you the flexibility. You've got all the moving averages in alignment. You get a little pop-up. You get a divergence signal. This is stochastic divergence right here. You can see the stochastic gives you a high. It gives you a lower high as price went higher. Boom. Low risk top, trades down. You get risk-free. The jury's still open on this chart as to whether you broke lower or not, but you can see never came back and smelled your stop. And if it did, we simply get out. We have no problems there. We're going to take stops from time to time, right? That's part of being a trader. Okay? I've already talked about the ATR range. Here's an example in the Dow on a 1-minute chart. If you would have just had your sell order at 16,309, look at how long, and this chart came from way over here to the left, but the market kind of waffled around. This is 10, 15, 20 minutes that it traded above these levels, spotted your divergence right here, gave you the trigger, stop goes right above the structure, and then over the course of 12, let's call it 1240 to 140, boom, market goes down. You've got about 60 points worth of profit in the bank, and then you're looking for the market to go lower. Okay? The ricochet, this is what my chart looks like. This is a 144 tick chart on the crude market. Now, interesting thing, you're going to get divergences on both sides of the market. We ignore the ones that are not in the direction of the trend. So you can see all the moving averages crossed. We took out structure here. So we're looking to buy the next pullback, not short the rally, right? So we're looking, boom, you get a pullback to the moving average channel. You get a divergence. You're in the trade here. You benefit from the market going up. In this case, it only went up about 28 cents. So that's only about 280 bucks in 3.5 minutes. And you know, that's to me, like I said, I'm from small town Virginia. That's really, really good money. I will take 4 or 5 of these all day and not even worry about you know, trying to hold overnight positions. That's just me. If you back this up to a daily or weekly chart, then you're good to go. You can, you know, this would be a instead of a 3-minute move, this would be a 3 to 5 day move for you. Okay, so and I know I've tried to pack a lot in here. I've tried to give you some good examples, at least pique your interest. Now let's talk about what we're offering today. As I'm about out of time. I got a few minutes, and then I'll open it up for questions. We normally sell the indicator package. Each one of these indicators are about $97 a piece. So the CCI, the RSI, the price channel, the MACD, and the stochastic. I use just about every single one of these in my trading, in my day trading. The MACD is more of a swing trading indicator as far as the divergence pattern goes. Normally, if you add those up, it's $485. We're doing today's special for 30 people, $197 for the year-end special. These indicators work with TradeStation, Ninja, and Thinkorswim, and you're not exclusive. So if you want Ninja, you can have Ninja. If you want Ninja and TradeStation, the one price gets you Ninja and TradeStation and Thinkorswim. You can install it on all 3 platforms. Okay, the indicators are available immediately for download. As soon as you order, you'll be sent a link, and you can download the indicators tonight and have them ready to go tomorrow for your trading. In order to take advantage of this, www.tradethesystem.com/ricochet. Put in your information, and like I said, you'll get an email automatically sent to you with a link to download these. But how does it go? Wait, I'm not through. There's more. Now, for today, we've added a couple of things. Today's bonus items, we've got 2 live on-demand sessions that we've recorded over the last few months. We've sold those for $197 each. We've got a 2-hour live trading session coming up that I'm going to do January 8th. Now, I'm going to give you the holidays to play with the indicator, and then I'm going to put you a start-to-finish trading plan that you can use in 2015 by using the divergence indicator. That's going to be January 8th, 9:15 to 11:15. We will record that. If you look at $197 each for the live trading course or for the on-demand sessions, and then you add another $197 for the 2-hour session, that's $591. We're not going to do $591. We're going to keep the same price, $197 with the indicator. So you get all of this for free for the same price. That's www.tradethesystem.com/ricochet. And let me clarify, because the slides actually didn't do exactly right. That's not $197 each. That's $197, and you get everything. You get the on-demand courses, you get the live trading session on January the 8th, which will be recorded, and you get the 5 indicators that you can put on TradeStation, Ninja, or Thinkorswim. That is for the first 30 people, and we've got an unconditional no questions asked money back guarantee. Again, that's www.tradethesystem.com/ricochet, and I can answer any questions. I think I've got a minute and a half, if I'm not mistaken. So let's see if we can get some questions answered. Do you get a lunch? No, we got to power through. Yeah, you got to learn all you can today, so there's no lunch. Do you use these in the trading room? I do. The trading room offer was from Pat Barham. I think that was Trade the System /room. We actually run the trading room. I use these live in the trading room. I noticed that the last example wasn't a tick chart. I use TOS, and their tick charts are not so desirable. No, I use it on a 1-minute chart as well. I like to dissect it. A TOS will actually go down to a 133 tick chart. So that's not a terrible chart to trade. That's actually a decent sized chart. You can limit your risk to about $100-150 a contract. Can we sign up for the room? Yes, you can for $7. Absolutely. What is the special indicator you use? Does it come with today's offer price? Yes. So let me go back and to the previous slide. Oh, come on. The indicator that I used was called the Ricochet. It is 5 different oscillators that you can use. You can use multiple ones, or you can just use one of them. So what you'll see is right here, these green dots with the red dot and these yellow crosses. That's 2 different indicators. I've got them both on the chart. You can format these things. You can make one of them purple if you want to. You can make one of them blue, or whatever you want to make them, but you can show all 5 of them on the same chart, or you can just show one of them. If you're only interested in MACD divergence, then you can show just one of them on the chart. You can do either way, and it kind of depends on your time frame. If you put this on a 50-tick chart, you're probably going to want to limit it to 1 or 2 divergence indicators. Otherwise, you're going to have these things showing up all over the place. If you're on like a 5-minute chart, then you can use more than, you can probably throw all of them up there, and the really good signals are going to be when 2 of them happen at the same time on the 5-minute chart. But yeah, they work on any time frames. You can put them on daily charts if you want to. These are all divergence indicators. Yes, they show different divergences: MACD, stochastic, RSI, CCI, and price channel divergence. Which one to use? I use a majority. I use 3 of the 5 very, very well, pretty much every day. I use the price channel, the CCI. Those 2 test out the best on the scalping time frames that I trade. The stochastic is also pretty good. I don't really like RSI. I don't like the RSI indicator, but there's a lot of people who like the RSI indicator. And then, like I said, the MACD is better for larger time frame trading, swing trading, on an hourly chart or something like that. Your MACD signals are really good. But so I'm not a big long-term trader, so I use them on, I use the price channel and the CCI the most. Can you put them on Winco charts? I don't know. I'm not sure if they work on Winco charts. I can try it and get back to you. If you shoot me an email with that question, Micheal@tradethesystem.com, I'll be more than happy to put it on one right after this presentation and get back to you and send you a screenshot of it. It works on stock. Does it work on stocks? It works on high volume stocks. It's not going to work on low volume stocks because not much works on low volume stock. They're a little too erratic. But yeah, it works on stocks as well. Can you install an indicator on TD Ameritrade? The Thinkorswim platform is under TD Ameritrade, so I'm going to say yes, it'll work on TD Ameritrade because Thinkorswim is TD Ameritrade. Kind of depends on which version are you using.
We got about 1 more minute left, Michael.
Okay, yeah, I'm just kind of blow through these questions. So there's the special while I'm answering more questions. Are you mostly trading off 144 tick charts and 1 minute charts? 144 tick is my preference. As if the markets get slower, I'll drill down to an 89 tick chart. If the markets get volatile or if there's a high volume market like the ES, I will go up to like 377 or 512 tick charts. 5 minute is about the highest that I like to go for day trades. Other than that, I'm going to be using options to manage the trades if I get in like that. Will it work on coffee? Coffee is a little bit thinner, coffee, live cattle, but if there's divergence present, yes, the indicator will spot it. You got to be careful on live cattle, coffee, wheat, things like that are pretty erratic. And you got to be careful in general, not just by divergence trading. You just got to be real cautious on thin markets. Do you like them better than NQ? I like them better than NASDAQ, but the indicators work just fine on the NASDAQ and the Russell. The NASDAQ's a little boring as far as I'm concerned. It looks. No, I don't think TTM has them. So I mean, you may, Paul, but as far as I know, I was the one that developed them, and they were branded under Trade the System. I don't know if they may be marketing them. I used to be partners with them. Okay, well that looks like that's the majority of the questions. Is Pat going to? Yeah. So the room offer. So and I'll be through here. www.tradethesystem.com/ricochet for the indicators. And just a reminder, if you liked Pat's presentation, I am in the room with Pat. That offer was www.tradethesystem.com/room. And you can email me with any questions or anything at michael@tradethesystem.com or support@tradethesystem.com. I would like to take the time once again to thank you all for your time. Reed, I appreciate the opportunity for being here again. Thank the guys, Reed and the guys, for putting on such an awesome presentation with a bunch of great information. Happy holidays, everyone. And again, if you have any questions, it's michael@tradethesystem.com.